James Dixon is co-chief European economist at Societe Generale. He worked at the European Central Bank, and he is joining us now from our London bureau. James, thanks so much for being with us. How much of the Hungarian change of heart is weighing on the common currency today?
Well, it's certainly a concern. I mean, the problem for Europe is that Hungary is a country under an IMF program, and if it balks at that and says it rejects the IMF-imposed austerity package, then, I mean, you carry that over and you think, well, Greece is likely to do the same. And so that's, that is a big weight on the euro at the moment.
How long do you think is it going to take for Europe to work through its debt crisis?
Well, I think that's the problem. The stabilization fund that has been put in place, the stabilization mechanism, has been very successful at really addressing the euro area's liquidity problems, but it hasn't really tackled the longer-term solvency issues, and they could potentially weigh on the euro for the next 3 years.
So is that a best-case scenario or a worst-case scenario, the 3 years?
Well, that's probably a best-case scenario. I mean, the problem is that for the southern European countries and Ireland, it will take at least 3 years to make any meaningful inroad into their fiscal positions and to be able to demonstrate to the markets that they're back onto a sustainable trajectory.
James, I'm curious that you mentioned Ireland. I didn't want to cut you off there, but I mean, Ireland has been held up as an example of what to do. But in your view, how many times can a government cut public sector debt, and by how much, without seeing some sort of civil unrest as we saw in Athens?
Well, I think that's the problem. I mean, Ireland very successfully at Christmas tried to sort of demonstrate to the markets that it had taken the bulk of the pain up front. But I think when you look at the figures, that just doesn't really stack up. They still have to come back next year and announce how they're going to cut spending, again, and then they have to make exactly the same, announcement the year after and the year after. And I think the problem is that what you saw in Ireland is the majority of the budget cuts have been basically on public sector salaries, and so you have to ask yourself, how many times can you do that? And of course, all the time you're cutting salaries, you're lowering incomes, and that's also impacting on GDP growth. So I think Ireland is also a very long way away from a sustainable debt trajectory.
But the threat, on the other hand, is it seems like any country that has greater than 5% debt is just going to have its debt punished by the market. Do you think that's the new de facto rule?
It does appear that way. I think, and this is the real problem, really, for the euro area and for the ECB. Having stepped in now and in the business of buying peripheral country debt and supporting the market, I think it's going to be very hard for the ECB to walk away. We are moving into a situation where, realistically, it's very hard for any of these countries to actually issue new debt and fund themselves in the market, and that is going to be an enormous headache.
So, James, I mean, we've talked about Ireland. We've even heard some people say that France is ripe for a downgrade. On a scale of 1 to 10, how likely is that, as we think of France and Germany, almost the mom and dad of the euro?
I think, France is a long way away from a downgrade. I mean, the larger core European countries, don't have the same sort of high debt levels and high fiscal deficits that are affecting some of the smaller peripheral economies. And critically, the larger economies have a more diverse tax base. There are plenty of ways to actually raise the revenue. What's needed is the political will to do it. So I think on a scale of 1 to 10, I think you'd have to put, a country like France, it's like a 1 or a 2. Very, very unlikely at this stage.
James, thanks so much for your thoughts. James Dixon joining us there from Societe Generale.